Hello, hello. Well, fantastic. Thank you very much. And thank you everyone for sticking around for the last panel of the day and our lovely speakers to let me berate them questions about local stablecoins. So let's do this first in an orderly fashion. Let everyone introduce themselves, tell them a bit about themselves, and then we can get started.
Should I start? Or the celebrity next to me?
No, I think you should start.
So, hi everyone. I'm very pleased to be here, not only here at this event, but in Buenos Aires again. Perhaps you cannot give by the accent, but I am Brazilian, and I do love to come here every single time. My name is Daniel Mangabeira. I am currently the VP for Policy and Strategy for Latin America at Circle, and I'm looking very much forward for this debate that we're going to have today.
Hello, everyone. Happy to be here too. Happy to be traveling to Brazil tonight. So we're going to switch countries. My name is Guido Messi. I run the institutional sales team at Ripio. It's an Argentinian crypto blockchain company. Although it's Argentinian, it already has expanded to 8 countries. So yeah, happy to talk about stablecoins.
Hi everyone, my name is Tony Olendo. I am the co-founder and chief janitor at ViFi Labs. We are building a DEX for non-USD stablecoins and just driving price discovery for these assets on chain.
Hey all, I'm Julian. I'm the head of ED of Gnosis. As Argentinian, I love stablecoins because we don't have one. And at Gnosis, we are building infrastructure for neobanks. And as such, obviously, stablecoins are really important, particularly local currency stablecoins. And we're going to all be talking about how to promote their usage.
Fantastic. I'm Tadeo, your host today, the intern at Capybaras, a crypto advisory firm bridging DeFi and TradFi. So to kick off the panel about local stablecoins, I would like to ask you why local stablecoins? And I'll do a bit of a preface as it's been so challenging to create a DeFi ecosystem with different AMMs and lending markets and derivative products built on top of them, and they all reference the same underlying asset being the US dollar. Why go through all the trouble of doing the same thing but for local currencies? And anyone can take this question.
Should I go? Okay. I think we can all agree that the US dollar is the dominating currency in the world, and that's fine. I don't think there's an immediate challenge on that. But there's another part of the reality, and that is that different countries still have their own local currencies. And if you go into those countries, everything is denominated in those currencies. People earn their wages, buy their groceries, rent their apartments. All of that is, I would say, 100% done locally on their own currency. If you go to Brazil, they might not even know the exchange rate. Something that in Argentina we prayed as a mantra every day. But outside Argentina, people are happy with their currencies. They don't get the sense that they're getting devaluated every single week. And that sets the stage, for a digital local currency, because you don't need it, but the proposition is that tokenizing money and bringing those assets on-chain is going to provide a far superior experience in terms of how you save, how you do transactions, how you fulfill contracts, how you do different things. So I would say I don't want to be blind to the fact that outside the US dollar, there are still a lot of countries with healthy currencies, and I don't think they're going anywhere. And so it makes sense after seeing what the US dollar stablecoin industry has done to come now with a proposition where every single financial industry in every country can have that same product, or at least something equivalent, and get all of the advantages of that network a blockchain, being the building foundation of those assets. So for me, it makes a lot of sense. And I'm happy that the US dollar has paved the way before that, because it has not only the technology, but the acceptance. And now that we know that the technology works, I think it's easier for local stablecoins to have a new go at this.
Yeah, to build on top of that, half of the Argentine economy is informal, and this is the largest denomination bill in Argentina. It's worth less than $15. So you can see how much of a pain it is to pay for things, right? In an economy like this. It's from him anyway, so you can pay him later.
Yeah. It's already a market here. Yeah. What's going on?
It's an artifact. Can you pass along so we can evaluate as well?
Yeah. So my point is, stablecoins really improve UX, right, of payments. In a country where half of the economy is nice.
Oh, that's the
how much is this?
What are those?
Wow, that's
Tony,
less than $1.
I lost. Well, another day in crypto. So going back to this, in a country where half of the economy is happening in cash, being able to tokenize this and improve the UX incredibly with the use of stablecoins, which is digital money being tracked by tax agencies, is going to be a massive improvement. It will save people thousands of hours for traveling to do payments. If you have a supplier in another province, it will save you maybe 6 hours per month to pay your suppliers, because you can simply do a transfer. And there's another topic, which is how do you or why would you do this on local stablecoins if it's already done on US dollars? I think the answer is you don't have to. The rails for dollar against local currencies already exist, and you don't really have to recreate that on chain. You can just tap on what already exists and bring that on chain.
Yeah, so just the additional points to make to that. I did a lot of work this year with the Kenyan government in terms of advocating for stablecoin policy and ensuring that we have a role for local currency stablecoins. I think an important piece that they play is monetary sovereignty. So from a monetary sovereignty standpoint, having a local currency stablecoin allows you to be able to price your crypto ecosystem. And so there's a way that you could actually enforce KYC, AML, and a lot of your local regulations on the local currency stablecoin to ensure that the central banks still have the same levers to be able to pull. And if on and off ramping is happening through the local currency stablecoin, then it basically restores that kind of monetary sovereignty that's important. The additional point I'd also like to make is that USD stablecoins represent a systemic risk to crypto. They are now a proxy for US sovereign debt. And if you're looking at the recent legislation that came out, I think last week or something, they have been enshrined as sinks for US sovereign debt. Now, are we comfortable taking this on as a core base asset that we're actually going to use to build this new future that we're looking at in terms of crypto and all of these things? Or are we going to price USD stablecoins as the increasingly risky asset that they will continue to be? So if you're okay with US inflation, then we would then be okay with the proliferation of USD stablecoins. But any half decent economist will tell you that they represent a systemic risk. And so we need to define a place and a role for our local currency stablecoins to be able to price our own tokenized RWAs that will be actually be coming on chain, and the need for us to denominate yield from different parts of the world in currencies that essentially support further innovation and monetary sovereignty.
Let me try and add one or 2 points, and I'm going to try to go back to the more structural aspect of your question as to why should we go down the trouble of issuing local stablecoins, right? I think that conceptually, it's hard to think of an idea of financial inclusion and monetary resilience with USD reference stablecoins only, right? And I think that for the sake of understanding the local idiosyncrasies of economies, it makes sense to think of a locally referenced stablecoin as well. That's the conceptual aspect of it, right? But I wanted to share 2 examples, and I think that the first one really builds on what both Guido and Julian just mentioned, just a short while ago. I think that when you think about regulatory projects, and then I'll take the liberty to go back to Brazil just to borrow what you mentioned. We do have a specific project about digitizing our local currency, right? We have a project on the Real Digital. It's named Drax, and it's hard to think that Drax having the penetration that is supposed to have without having a locally referenced stablecoin, right? So again, we do have the dollar reference stablecoin serving different purposes like internationalization, international trade, remittance, all of that. But for the sake of the internal economy, for the sake of monetary resilience, for the sake of regulatory compliance, it makes sense to think in terms of a locally referenced stablecoin. But the other thing that I think is way more interesting, and again, I hadn't think about that, but it got me when you show the peso, right? Or, the paper. Because to me, when we think about stablecoins, we're thinking about infrastructure more than anything, right? We're thinking about, the structure of the monetary rails of the future. Potentially, it costs more money to issue that piece of paper than the amount of value that the piece of paper actually carries. That is so counterintuitive. It makes no sense whatsoever, right? So a piece of paper holds less value than the cost to produce it. And I think that the reason why that happened, and again, I'm speculating, right? Perhaps that's the case, but just to illustrate my speech, perhaps it makes more sense for us to think about how can we build structures that are more cost effective and that allows for a more cost-effective use of our resources in our society. And I think that the technology that is brought by, blockchain and stablecoin and digital assets more broadly understood is part of the answer to that.
Actually, in 2023, we were importing pesos bills from Brazil.
Yeah, and just to clarify, the globally accepted benchmark for the cost of producing a bill should come in at less than 1.5% of the actual value of the note, which in most currencies, it doesn't quite cut it, yeah.
So we've been, I think as an industry, we've been focusing quite a bit on building the foundational rails or the infrastructure for all these things to actually happen. And we keep saying that mainstream adoption is about to crystallize, and this year is going to be the year, and it hasn't been the case. So talking about, I'm focusing more on the last mile and basically reaching the actual customer of stablecoins. What do you think are the key elements for that adoption? I feel like from a Circle's perspective, this might be quite a different strategy than what Gnosis has in mind. So I'd love to hear your opinions, differing opinions, if they do exist.
Go for it.
I think there's a couple of aspects to the question. Generally speaking, the stable coin that is going to win is the one that wins at distribution, and the one that will win distribution is the one that is going to get their hands dirty. It's a stablecoin issuer that will go to talk to merchants and get them to accept the stablecoin. That's going to talk to shopping malls. It's going to go to where the economy is most transacted in cash and convince them why this is more convenient than carrying a bunch of bills. As long as they are good educating them on both the benefits and how to do it, they're going to be able to do it. Regarding what we are doing at Gnosis, we are creating an API. It's called Gnosis Ramps. That's going to wrap all stablecoin issuers API. We're going to create on-chain FX markets and are going to enable users from all around the world to on and off ramp to crypto. Wallets can tap into our APIs no matter what their chain is. They simply integrate one API, use their KYCs with Gnosis ones, and they get access to, we do KYC sharing with them. So the user, it abstracts away all of the issues, implying that having to KYC over and over and over again with a lot of different providers. And I was telling Guido before, like there's 500,000 Argentinians living in Spain, as I am, and we all have to pay for the shrink. So I remember a few months ago, I tried to get my girlfriend to swap from euros to pesos using centralized exchanges and stuff. She didn't have any account. It took her 14 steps. She had to register in a bunch of different exchanges, KYC in all of them, transfer, learn what the fuck is Polygon or whatever, or something that was the cheapest one. What is this 0x weird thing, We are creating the infrastructure for abstracting all of this. Users don't really need to know that crypto is being used. That's just the backend. It's the backend of the future of finance. In the end, it's just an app where you sign up with your face and you KYC once, just like in any normal financial app. And then that's it. You get access to, you're able to tap into the global liquidity layer. You get all of the access to great financial products that if you don't live in the US or in Europe, you might not get access to. And it's just a few clicks away.
Can I go after you? Use that as a segue? I promise I'm going to go quick on this because I very much agree with everything that you said. But I do think there is some obvious other elements that normally they're not taking into as much consideration as they should, I guess. And they're very simple. Perhaps people in the back are going to think that what I'm saying is dumb, but what we see is that UX counts a lot. And again, crypto is not trivial. And for people who is part of that universe, has been using that for a long time, perhaps then again, it goes without thinking. But for new entrants, and especially while we dive into, economies more deeply, we get more penetration, we get more institutional use, UX is going to be more and more important. And right now, I don't think it's being given the attention that it should. Right? So I think that UX to me is a big thing. The other thing is that, again, thinking about last mile, right? On and off ramps is instrumental. But the reason why I mentioned that is because I think this is going to be very closely connected to regulatory advancements. And I think that then again, coming from Brazil not too long ago, on and off ramping was a nightmare, right? Because again, financial institutions or banking institutions, those guys are shying away like crazy from crypto. Up until the moment where regulators started to step in and provide some endorsement to the industry in the sector, things change like from water to wine. From wine because I'm in Argentina, of course. But I think this is very important as well. So again, thinking about UX, thinking about how regulation is going to play a very important role. I think this is going to be key for last mile adoption and for us to have strengthened penetration in countries and markets.
One of the things I feel like we're downplaying is the powerhouse that financial industry is. I think distribution here is key. In our case, for example, not through stablecoins but through other tokens. Since we've it turned into going into B2B strategy, not so much as a wallet, an exchange. We've signed with partners like, I don't know, Banco Itaú or Mercado Libre, and we've seen adoption go through the roof in terms of, wallets, stablecoin usage, and stuff like that. So one of the things that I want to see is, the crypto industry just providing products for the existing financial industry. I don't care how much we try to put banks and neobanks and brokers on a spot where, we feel like they're old, out of fashion or anything like that. I know for a fact, I've been working with them for more than 20 years. They still hold a very significant grip on how, money moves around. And I think it's a bit childish to ignore that. And I think it's a much more mature proposition to go through them and just to build products that they can consume. And eventually their customers, they're just going to go into their bank application, neobank, Revolut, you name it. And they're just going to consume the product as it is. And so I think we should pay a lot more attention to that. And I think it goes to the fact that you were saying just yet, regulation. For example, we need banks to be, sure that they can go into this technology without taking any more risks. And that's not there yet. And I think once that is made clear, there's going to be a gap there when they have to catch up with things. But, I've been selling to banks and brokers for the last 2 years, and there's no innovation and product team on a bank that is not talking about this. Mm-hmm. It's not like they're dinosaurs and they just don't get it. They really get it. They're a customer of us, and they're just waiting to be able to do it. So once that is done, I think distribution is going to be huge.
Yeah. Just to echo your point here, Messi. I think for me, when we started off the whole discovery of how to build a decentralized protocol for FX, we had this whole, pitchforks burning in front of the central bank type approach that was guided by our Bitcoin, maxi philosophy. And then over time we found, it's businesses that are using that are using stablecoins more than anybody else. And in the customer discovery process, you realize it's people who really have very real, legitimate growing concerns. I have a supply chain. I need to pay my manufacturers in China, and they are suddenly accepting USDT, and I need USDT. What the hell is USDT? Can you actually help me? You get that, and then you have the whole kind of process that they're actually trying to go through to secure all of these funds and all these things. And so I think the role and the place that we see the on-chain FX component of local currency stablecoins play out is that we needed an on-chain FX venue that would give you the price discovery that you need. Now, the problem with our economies is that there's no single rate for USD. Argentinians know this more than anybody else, right? Kenyans have the same problem.
And there's a whole industry that doesn't want a single rate.
There's a whole that's a whole other layer that you want to be able to delve into. And so for us who are building a decentralized protocol, we have to be able to allow for arbitrage and people to drive their own price discovery for these USD stablecoins, but still enshrining a role and a place for the local currency stablecoins as a pathway to that, so that we could retain monetary sovereignty, but still have a means for people to be able to get access to USD stablecoins at scale. And so the reality of the parallel market rate, I think, it's actually something that is often overlooked when people are designing on-chain FX solutions. And the impact of you not really aligning the incentives that are required is that we have what we see today, where most local currency stablecoins have very shallow pools of less than 50,000 USDC, be it on Aerodrome, be it on Uniswap, be it on all of these venues. You have people designing good friends at Circle RFQ systems where it's going to be one-sided demand because nobody wants to hold the peso as much as they want to hold the US dollar. So it's these types of like really pertinent problems that we living in these emerging markets live and breathe, I think have to rise to the occasion and design different solutions. We have one take, I want to see 50 others. In terms of just like how exactly can we solve this particular problem, and how exactly can you do it in a way that is credibly neutral, that is permissionless, that allows for like free and fair price discovery in a way that could actually gain the trust of all of these players inside of the ecosystem, where there is no house that is winning, but there is like a decentralized, permissionless, credibly neutral protocol that allows for very clear and like fair price discovery. Yeah.
Fantastic. So financial products have been quite unique in the sense that they are this quite peculiar product that the poorer you are, the more expensive they are. You have developing countries where there is a huge margin at which financial companies operate at, which the users are paying for to access these products. And if you go to more developed economies, those prices basically bottom out, and there's quite a bit of competition. Also means that the user is also quite richer, therefore the opportunity to capture that value is higher. So my question on this is, how do you feel about, how do you quantify the benefit of an opportunity of going to tackle a specific currency? I know, for example, Circle has the euro stablecoin. Why is your decision-making process of deciding which is the next currency that should come on chain and that you want to service those users? And this is questions, obviously, for everyone applied.
I'll take that as a cue since you mentioned Circle at the beginning. I think this is a deep question, honestly. I don't think that's a simple one. I think that there's many variables that guide that thinking and that decision-making, right? I think that, again, not to lose the thread, but regulation is definitely one of them, just because you mentioned EURC, which was to some extent a consequence and a byproduct of the MiCA framework and of our desire to keep on servicing the European market. So that is one. But I think that the other variables they address also they touch the opportunity that the market presents, I guess. I think that bottom line to me, when I think about this, and then again I'm going to take a couple steps back and talk more conceptually again. To me, instead of talking about the specifics of local regulations, it's important to me to try and mention the philosophy around it, right? And I think that fast forward a few years, when I think about how the world is going to be, or at least how we would like the world to be, it's going to be a world punctuated by locally referenced stablecoins, but with this broader global settlement layer, which potentially is going to be provided by USD reference tokens, right? Because then again, of the reach and the monetary power behind it. But I guess in the end of the day, trying to answer more objectively to your question, I think that the variables are too many, from the commercial opportunity to the regulation around that. I think that for us at Circle is normally a reactive process. And then again, we spot the opportunity, we try to work around it accordingly.
Well, for us, I think it was a combination of things. It's never one factor, but one of the factors is that Ripio already has a footprint in 7 different countries, and we have clients on those countries, and several of those bigger clients, they need a product that can bridge countries. They have like the same customer base, and they are so Web3 that they don't even look at countries like countries, they're just customer base. But eventually those customers needed a product. So, it made a lot of sense for us to go ahead and start building. And the other thing is our CEO, Sebastian, and all of the C-level suite, they're just builders. They just want to build. It's amazing. So it was, it was just a matter of time till they wanted to build this project. And I think it also came to a point where we realized that we've struggled with banks all over the world. We've struggled with FX rates. We've struggled with providing like a way for customers of us in different countries to trade with each other. Although we were in 7 different countries, a Mexican client in Ripio couldn't do transactions in an easy way with an Argentinian customers. They were just 2 different companies providing the same product, but they weren't connected. So at some point, it made a lot of sense for us to start building, a way to connect things on chain. And from that idea, we've started talking to partners. So there's a commercial side of it, like you mentioned, and we started talking to maybe not partners, but some guys on different industries. And for example, the FX industry, I think there's a huge opportunity there for non-US stablecoins to start building synthetic swaps for those currencies. And I think and it's a great solution. I mean, the FX market is still it looks like kind of old dated because you're just swapping coins and that's it. But it's a huge industry, it's a huge business, and it's a huge part of what our customers actually need when they move money around. It sounds like a bit dull, but it is. It's a huge industry. So those are part of the things that started us with providing local stablecoins, and so far the reaction has been great. I mean, not only the crypto industry has been vouching for us, but also our customers and all of those financial institutions. They all see like an advantage in settling and moving money on chain rather than through local compensation agencies, because they actually have a pain point there. Capital markets, for example, they settle on 24 hours later. So having a better settlement layer makes sense for them. So yeah, a lot of things going on there.
Yeah, so we've been jamming on this particular problem of FX for about 2 years now. In designing a decentralized protocol, where I have lived a life as a economist. I have spoken to regulators and legislators, helped draft legislation, and run the gamut of talking to OTC desks and from people who deliver money on motorcycles at night to people who sit as CFOs and are helping them design stablecoin strategies. I think the utility of these local currency stablecoins will continue to soar. Generally, FX is a 7.1 trillion daily trading market, 7.1 trillion daily. If you take out G20 currencies, you're still talking about like close to $1 trillion. If you're looking at our launch markets, Nigeria does 600 million daily spot trading on FX. Brazil, according to my numbers, is 7 billion daily spot trading. Colombia is 1 billion. Why don't we have a decentralized protocol that's powering this? What's the next stage? If you have a decentralized protocol that gives you price discovery between these particular local currency stablecoins, like my dream is a Nigerian businessman no longer needs to hold USD. They could just fly to a destination country and swap using a decentralized protocol instantly on chain. We don't have that infrastructure yet. We have a single take. We hope other people will have others. But the very crucial role is you really need to be able to lock in on the regulatory aspect. And local currency stablecoins play a very pivotal role because they are the gatekeepers to the domestic financial system. And so we have a responsibility to ensure monetary sovereignty and that our economies do not end up worse than they were before, but also democratize USD access in a way that the future that I want to live in is that manufacturer who's importing 100 pieces or 1,000 pieces, because they're running on blockchain rails, they can now afford to import 1,200 pieces and sell it a little bit cheaper. And so with that, because you fix the USD efficiency problem, it means they could do more volume and people could get goods and services at a cheaper rate. And that, for me, is the future that we want to build and hope for. Yeah.
I don't have a lot to add. Just two things. First, regarding where do we head next? Which stablecoin? I think we want to onboard them all. We are pretty sure that the future of finance is going to happen on chain. And it's significantly better that it happens on a neutral chain operated by, a very wide network of validators, geographically distributed, than via a centralized entity like Circle. If I'm a stablecoin issuer, I don't want to go to Stripe network or Circle network or Tether network. I want this to be neutral, because if I'm issuing Brazilian reais and at some point Circle decides to issue Brazilian reais and my business depends on Circle, that's going to be very problematic. So that's our vision. Regarding quantifying the opportunity, I think around 5% of the whole transaction volume of payments is US dollar based, but 99% of the stablecoins on chain are US dollar based. That is clearly a problem there. So that means that we are really starting to see the scratch of what local stablecoins can do.
Fantastic. I appreciate your time. I would like to give you, each one of you, some time for closing remarks if you'd like. If not, I would thank you again for this.
Let me just kick off, because I wanted to echo very quickly what Julian said. Not reacting to the Circle, but I think it's a fair comment, by the way.
Go ahead, this is a panel, right?
I think that I know, reacting to you and combined with what Tony and Guido said, we're talking about the opportunity and how huge FX as a market is, but we are in Latin America right now, and we are seeing governments and regulations whose attempt is to bring the whole real economy digital. And when we talk about an opportunity, this is a huge opportunity. Brazil's economy has a $2 trillion GDP, Argentina 700 billion or something. I might be mistaken, I'm sorry.
That's a bit sad.
Around that.
That was a cheap shot?
It wasn't intended, I promise. But I think that this is a huge opportunity. And when we talk about that, when we talk about bringing the whole real economy digital, I think there is potential for us to solve one long-lasting problem, which is credit. The price of money in our region is very expensive. When we think about digitizing the economy, offering that as collateral, lowering the cost of money, that could unlock many, many opportunities for our people in our region when it comes to the real economy. And I think that's tremendous. And I think that we only scratching the surface. There's a lot for us to see and execute on that front. So on that note, I would love to thank for the opportunity. It was a blast. I mean, I've learned a lot from you guys as well. Thanks so much for having me. I hope that again I could contribute, and always available for other discussions with that high caliber.
Well, I mean, last remarks. I would say the second half of this year has been very, very interesting for Ripio, and I would say for Argentina. There has been significant progress on regulation. There's been, a new opportunity has given way in terms of tokenizing capital markets. We are taking advantage of that, and we're providing products so that everybody can, go ahead and start using tokenized assets. And we've been starting to tokenize pesos, and we're going to tokenize Mexican pesos, Colombian COPs, Brazilian reais, because we think that's the future that we want to provide our customers. But also because I think, I mentioned a couple of times, the distribution effect. I think that is coming. I'm seeing it as we speak to new customers. And I think that's going to be like a huge boost to the way, these products are starting to get used. So I would encourage everyone to start using, local stablecoins. They're going to find that being on-chain and on a tokenized economy is much easier than you would think. I think we've made a lot of progress so far, and eventually, the effects of this being used more is going to bring a lot of opportunity and eventually the adoption that we expect. So thanks again.
Cool. I don't know what to say in the interest of time, so I'm just gonna say thank you guys for the discussion. Yeah, it's been great.
Yeah, same. Thanks everyone. And if you are a stablecoin issuer, you're working in a new stablecoin, non-dollar, please reach out. We're going to support you, help you with liquidity, distribution, and use cases. We're going to be around, and that's it.
Great. I want to thank your audience and our host for today. Thank you for sticking around.
Thank you.